happens. And it's going to be hard to compete once on a big data scale with those companies who own all the inputs from our consumer searches and what we freely give them anyways. But let me ask you, Gavin, I mean, if you were just to say right now, big data, good or bad, I mean, I know you touched on it a little bit, but what are we thinking?
Yeah, if I had to boil it down, I would say overall, I think it's good. I would say more so on the potential side. As far as it's been actualized, I think the majority of the value from big data has been in targeted advertisements. If you look at like the value generation,
Yeah.
that's like what big data is really good at doing, is serving you products that you're more likely to purchase. So I'd say that's, pretty low in terms of like, it's not helping society. Maybe it's like not hurting society necessarily, but where I do think big data is like incredible. And I'll bring up just a few examples. Google Translate is leverage big data to basically take their translation from being like, I don't know, 85% performant, like let's just say, these are made up numbers, but to like way closer to like 98% performant, like reached a critical threshold where they had enough linguistics data, and then all of a sudden it worked way better than anything else that had existed beforehand. Computer vision for medical applications. That's something that is incredible as far as image segmentation. There's a lot of efforts to like identify tumors from like a brain scan, and instead of having to have somebody who is trained and goes to multiple years of college to go and look at those diagrams, they can have a computer algorithm that highlights them with close to human accuracy, and you can still have somebody to review that. Obviously, you're not just completely relying on it, but that stuff is, that potential to be life-saving and pretty incredible application there. And then I'd say just computer vision stuff beyond that, like self-driving cars. I think that's the obvious,
right.
Kind of the pipe dream, and I think that will happen within our lifetimes. I don't know exactly how long it's going to take to get it to that last edge to where it'll be safer than human drivers, but it's getting close, and I think that'll be revolutionary. I mean, huge, labor saving there. And then there's a lot of kind of niche, interesting things that have been done that aren't valuable, but I just think are really interesting. Like the game Go, which is like a board game, kind of like chess, but there's a bunch of, anyways, they have like Google had a deep learning algorithm that is better than any, player ever could be at it. So like stuff like that's definitely really interesting.
Like what IBM's doing with Watson and everything.
Yeah. Oh, and one more thing I just thought of is oil drilling. I actually thought was a really interesting application. They were using image segmentation and stuff to identify drill sites that were more likely to yield oil based off of like various geological and different imaging data that they had. So I thought that was an interesting one, and something that is good for everybody, because even if you don't think that we should be drilling for oil, it's still better that they are able to find the oil in one drill rather than 5 kind of thing. So
well, I think, and I want to go back to you really quick on, because I think you were just about to get into it, but I find big data, like you were saying, so like I'm NBA, right? Big data came into fruition about 10 years ago, where it really took off with Bill James, the baseball guy, and then it kind of got adopted to NBA, and it's just taken over the NBA, and statistics have become all this thing where you measure players and everything. And it's not a matter of anymore, can you use big data? It's been proven you can use these data points to evaluate players. It's now moved in, should you, right? So we've moved from the exploratory can to now the moralistic should. And I'm wondering with you we're starting to go into it of, you know, there we have to ask ourselves as a society what we allow big data to be used for, right? So I think we've gone through the exploratory section of can we, right? And maybe from what I'm hearing from you, we should be now asking ourselves as citizens, as consumers, everything, should we? And what are those things that should we? Is that correct? Am I hearing you correctly when you say that?
Yeah, no, I think that, yeah, absolutely. I mean, the question is not can we? It's been proven that we can do it in more than a few domains. And I would just say, yeah, I think it depends on the domain. Like, if you're talking about computer vision for cars, I think, yeah, you should try and tell, because I mean, imagine a world where you don't have to drive your car and it just gets you from point A to like, and if it's safer too, like if we can get there, absolutely should, I think 100%. Um, the domains where I think it's tricky and where I would say probably strongly considered no, would be like, yeah, criminal justice stuff. I think that is super slippery.
Right.
And I don't know, have you seen that, uh, what, the Minority Report? It's like they have
Yes. Yeah. The pre-crime.
the precogs. Yeah, yeah. You know, that's kind of like it gets into, there's some deep mirror or what is it, Black Mirror uh type stuff where it's like you don't want to live in a society where you've given up autonomy to the robots, so to speak, on important things like, I think, like, yeah, uh anything that has to do with like social equity should be very concerned about. Like, I would even be pretty concerned about, you know, if you're using an algorithm to determine someone's likelihood to like pay a loan back, stuff like that. I think you get really tricky
Yeah.
because you could accidentally be biasing, you know, without your knowledge too, and then you could kind of ride that data moral wave and say, you know, well, it's what the data said, so you know,
At
you don't
some,
have to think twice about it.
you know, going back to what you said about the free market and how you actually see it as a danger, that you bring up a good point because I could really see that being a danger. I mean, think about people who were able to get a loan in 1950, right? You were able, it was very different than how getting a loan today is, right? With credit score, you have to, and not necessarily a bad thing from a company perspective, right? I mean, if I'm a corporate bank, I want to know as much as I can about you to see how am I going to repay back the loan. But I do see us getting into dangerous territories of where we're starting to base it off of everything about that person. We're putting a number on them instead of seeing them as a person and seeing them as an opportunity of what they can do. We turn off our ears and we just look at a statistic with our eyes. And I think we could easily get there in the next 10 to 15, 20 years if it's just saying, oh, no, you don't, your number's too low, whatever that is, you know? I mean, is that what you're saying?
Yeah, I worry that that algorithmic approaches, solely using algorithmic approaches, will create a lot of self-fulfilling prophecies
Mm.
and will blind us to um, potential that is outside of kind of the system that algorithm will create. Because you, like, I think generally speaking, from a capital perspective, like somebody's more likely to succeed generally if they are lent money than if they're not. So, you know,
Yeah.
you're going to get metrics that, I mean, there's ways in which you should be able to capture these effects and do experimentation, but it would be tread very carefully.
Well, and you and I both know, like you were saying, you can make data look at however you want. And I don't think the layman is going to understand that process, and they're just going to be like, okay, well, I guess, because it takes some really smart people to get anything out of data, right? I mean, and even those smart people, they're human. They can make mistakes. There's an element of human error of how they relate data. So that is kind of concerning, you know, that there is an element of mistake, you know, in how we interpolate the data itself. I really love this conversation. I think big data is interesting how it affects every part of our life. Like it just does. And it's being collected from us at every level. And we just have to understand And I really like the moralistic viewpoint you brought into it, because that is something we have to take into account of how we demand our society to handle these things that are being taken from us just by our consumerism and what we do throughout the day. I'm going to talk to you about the Fed. So when I just say, what is the Fed doing? What's your initial reaction? What's going on?
Well, I think what's happening is the Fed has used all of its tools in its toolkit in terms of stimulate, uh, stimulating fiscal policy and monetary policy with their balance sheet and this historically low interest rate environment. I think that now that they're seeing inflation, they're kind of between a rock and a hard place where they have to choose one of their two mandates, which is either keeping their mandate is to keep unemployment low and to keep inflation at its target rate.
Right.
And I think that we're seeing a point where if they do not raise rates, then we will see inflation continue to take off.
Right.
And I also think that just something I want to throw, since we're talking from a moralist frame point, I think
Right.
that there is a real moral hazard with the general paradigm of a recession happens and then the federal government steps in to ensure that there's a soft landing, especially if it's overstimulatory. I think it incentivizes people to take on more risk than they otherwise would be comfortable with in an efficient market. And I think that my primary concern is that it is going to lead to an asset bubble. Yes, those are my general thoughts.
Well, just for those who don't know, in December, the 12-month change in the Consumer Price Index (CPI) was 7%, while core CPI inflation was 5.5% over the same period. So, prime was around 3.25 for that entire, around 3 actually for that whole year. So, I mean, we're at an inflation deficit, absolutely. And the Fed in January 25th and 26th, their goals were to, as you said correctly, combat inflation and try to reduce the uptick in unemployment in a effective way that isn't hurting the American people in the lowest way possible. Of course, that's what they want, as we all want. In support of these goals, the committee decided to keep the target range for the federal funds rate at 0 to 1.125%, which it's not the 0.5 BPS 50 points base points that they were talking about that they were going to do, but they are talking about doing 3 to 4 rate hikes in the next, year, and really looking at reducing their balance sheet. They will increase their holdings in Treasury securities by at least $20 billion per month, and agency mortgage-backed securities by at least $10 billion per month. So they're working, but rate hikes are in the future, and we're looking at some of the most extreme rate hikes after March, because they've talked about that's when it's going to happen. For those who don't know, Gavin, talk about why they actually increase rates to combat inflation, how they do that through their bonds and bills, and what just the strategies the Fed does in order to do that by their holdings and their buying.
Sure. So I'm going to get a little bit of the nitty gritty. I'm going to kind of hand wave over it because, quite frankly, I don't remember the exact mechanism, but I think just the general idea is that when they raise the interest rates, it's making debt more expensive, essentially. So, and then also on the other side of it, with quantitative easing, before they're purchasing like all these mortgage-backed securities and stuff. So they're affecting the interest rates by being it's making it easier to lend money into the economy, like because they can just immediately sell that
Right.
mortgage to the federal government. So when they raise rates, it's kind of like pumping the brakes, so to speak, because it's uh, reducing the amount of money that will be lent out in the economy, which will uh, typically have a suppressing effect on prices because your debt costs are higher.
Mm-hmm.
So when you have a super low rate environment like we've had for the past few years here, um, it's a lot cheaper to get a 30-year mortgage than it is otherwise. And so if it's cheaper to take out a bigger mortgage, that means more money in the economy. You can see how it stimulates it. But
Right.
Um, the risk is in the overstimulation is when you have too much money chasing too few investments, then you will just get a devaluing of the dollar relative to the investment opportunities that exist. And um, you know that's where you can get that inflation that uh, will kind of happen if the money stays perpetually cheap to borrow,
Right.
given kind of the activity that's happening.
Well, and I know they've been claiming, the Fed and anybody who's in the camp of that this is all transitory uh, inflation, that this is because of supply chain defects, because of coronavirus and everything going on there, that this is transitory inflation, and that they're actually, that's some of the reason they're doing these little rate hikes instead of doing more drastic rate hikes, because they think that this is transitory inflation, and once supply chains get going past COVID, that we'll actually see inflation go down in the sectors that they're the most concerned about. Auto purchases,
Right.
even home purchases, all those kind of things that we've seen incredible inflation in the last year, 18 months. They can do it through the reduction on their balance sheet. They are slated to do 1.4 trillion reduction, but that only accounts for 2 rate hikes. And this is by Kathy Bostjanic, head of the U.S. financial market economist at Oxford Economics. But they're expecting 4 rate hikes. So that's why we see the raise in basis points, because once they can do it through their balance sheet, but it's not going to be enough. And so that's when they actually have to increase the base points price. So just wanted to clarify that. I appreciate your explanation, because that is the nitty gritty kind of it and what that means. And this is what they're expecting to do in the future. But do you believe that it's transitory? I mean, do you think that this is because of coronavirus?
Yeah. So I think the sticky part here is, so defining transitory, I would say
Correct.
inflation is transitory so long as you tie it to how long the pandemic will be causing these supply chain disruptions. And I think it's fairly probable that these supply chain disruptions will continue for the next 2-3 years. And so that's where you're getting into like a discussion of, I mean, the transitory in the sense that if they're able to get folks vaccinated and or otherwise, the disease just becomes, if COVID becomes less deadly and less disruptive, then I think that transitory argument holds more weight. But if we're going to see those effects longer term, then I would say that it's almost moot if you're calling it transitory, because if it's going to take 3 or 4 years, then like I guess it's transitory, but that's a long time to have transitory inflation. I do think though, absolutely. Once the supply chain issues get figured out, the cost of goods in the United States will become cheaper. The other question I have is how long will the effects on consumer spending in the United States that were the changes in consumer behavior caused by the pandemic, how sticky will those be? Because Americans shifted their basket of goods and services to be much more good heavy
Right.
during the
Assets.
pandemic than previous. So good prices have gone way up because there's more money chasing fewer goods, both because so it's like this two-pronged thing that's happening.
Right.
Um, so I think that's a big question. And then as far as the supply push, I think that the supply push should be the transitory part. The demand pull is kind of yet to be seen, because I think that there is the potential that there are some persistent effects from the pandemic that just like, I don't know for sure, but I would imagine it's plausible that folks kind of permanently change, maybe not to this level, but permanently change their uh, predisposition towards spending more money on goods versus services, especially like if work from home is more common. I could see people generally just spending more money on goods rather than services, but I don't know. That's just kind of a hunch. And then what else?
Well, let me pause you right there while you think of what, when you say asset bubble, and you've kind of been hinting around it, what what does an asset bubble look like? I mean, we understand it from the terms, I think probably people who aren't experts in the industry, of 2007 through 2009 of the housing crisis. I mean, that was one asset, but I don't think, based on what I'm seeing, it's not going to be a housing bubble again. It's going to be a culmination of households and everything that they bought during these 2.5 years. Is that, explain what you mean by asset bubble?
Sure. So when I'm referring to an asset bubble, I'm specifically referring to just the investment class of things that people buy. So the biggest sector of investments as total value in the US economy is real estate. And then I think it's bonds. And then I think stocks. And then there's other smaller markets beyond that. So what I think happened is when the Federal Reserve printed like what 20 or so years of money in during the pandemic, this money has to go somewhere. And I think that the reason why we haven't seen the CPI, the Consumer Price Index, which is focusing on consumer goods, skyrocket like we have other asset classes, like we've seen housing has exploded,
Right.
stocks have exploded, bonds not as much, but there's still been growth. And then like these other niche risk asset classes like crypto have also exploded. I think that's a direct cause. The direct cause of those assets exploding in value is because of the cheapness in which, um, because of how cheap debt was, and because of the stimulus, all of the
Right.
money that was pumped in.
Yeah.
I think that the issue
PPP
is,
and everything.
though, is that the velocity of the money that's tied to, so the rate at which people are willing to spend the money that they received from that stimulus, I think the majority of that money went into investments, and only a little bit went into consumer goods. I think definitely some went into consumer goods, which partially explains some of that inflation. But I think that most people got that money and they said, well, this is money I didn't have before. I'm just going to save it. And so where can I put it? Well, real estate, stocks, bonds, crypto,
Right.
And so I think that the issue with that, though, is because there are fundamentals that determine the return on those assets themselves, right? Like real estate, a big part of the valuation that comes from real estate, that especially anything that isn't single family, is the rents that you can extract from
Absolutely.
it and the
Yeah.
expected appreciation.
Right.
So what I worry is if we don't see wages grow at a similar rate
Yeah.
to real estate prices, I think that the increase in valuation won't be sustainable. But again, I think that it is questionable. There's no hard written rule that says that U.S. real estate has to remain affordable relative to what it was historically. If you look at like the price to income ratio for real estate in the United States, it's like 3 to 4. So like 3 to 4 years of the median income is about what can buy an average house. But now we're like at 9. like where I live, it's like, yeah, 9 or 10.
Right.
Um, and so I worry that's what I'm calling an asset bubble, is I worry that the underlying economy that actually makes these investments work hasn't caught up to the increase in the valuation of the assets themselves.
Right.
Um, and I think that we are heading for a potential area right now where, as rates rise, home affordability is going down, and it's making real estate a less attractive investment. Not for people who are actually living in the homes, but for investors, right? Because as debt becomes more expensive, it's harder to leverage yourself and get more and more
Absolutely.
properties. Um, while at the same time, inflation will be eating into renters' ability to pay higher rents, um, and as well as the 1.4 million new construction units that are coming online here. I think that it could be a bit of a storm. I don't think that real estate would be the first domino to fall. And to me, I don't think that we're talking about a 50% crash or extreme
No.
crash like we saw in 2008. And I think that it's always, real estate's always local too. I think that areas that are able to maintain high wage jobs, and if they're relatively stable, like I don't think that San Francisco prices are, even though they're crazy exorbitant, given the wages of that area,
Right.
they're not as insane. And there's a lot of, don't get me started on San Francisco
Yeah.
real estate. A lot of weird stuff going on there with
Right.
like Prop 13 and the property tax situation that just makes it like, uh, you know, it's unreasonably accommodative, or it's unreasonably accommodating for the owners, so they have like no incentive to sell. But so yeah, I don't know. It's just a general worry that I have. I think the first thing to happen, because like what has happened in the past when rates have risen, like the Fed does not have a good track record with raising rates
No.
and not causing a recession.
Right.
So I worry that if a recession were to occur, first thing we're going to see is the stock market's gonna go
Well,
first.
and we're starting to see that a little bit, actually. I mean, the Dow and NASDAQ, I mean, in the past week, I mean, we're seeing incredible, not incredible, but definitely significant drops that we have to pay attention to.
Right. There's a lot of volatility and increased volatility. I know with potential Ukraine invasion, markets were freaking out too. But I still think that the biggest thing that, at least historically, people have keyed into, I think, is those rate hikes, because it's just everybody has to kind of tighten their belt. It's a lot harder for companies to maintain the level of debt that they had before. It's, which also contracts, be hiring less people, and kind of a lot of things that can happen. But I don't think you can time these things. Like that's the issue. It's like I can go and say, well, I think that there's a lot of, I wouldn't even say necessarily red flags. I read an article where an economist was talking about it. They were saying, if anything, we're seeing yellow flags. Like this isn't, um, the indicators we're seeing isn't super bullish, but it's, there's definitely cause for concern.
Right. It's not 2006 where it was a little more sleeping in the shadows, where unless you were really looking at what was happening in the housing industry with the rating systems and companies and in the foreclosure rates and the lenders, you would never know. We're getting a bigger picture of everything, which I think causes us to be able to see more alerts. And I think the general population, whether those from government to anywhere, are like, oh, let's take a look at this a little more closely than just like, let's be bullish and continue on forward with our head in the sand, which was what was happening in 2006, because it was more of a sleeping giant. I did want to ask you, I didn't get to it, and I think we can cover this in maybe quick 3 to 4 minutes.
Yeah, time. So whatever you're looking for on your end.
Okay. Practically, if somebody's trying to take advantage of the market right now, with rates being what they are,
sure,
And obviously resources are scarce. Scarcity is a thing. We all have a finite amount of resources. What are some strategies and ways that you can do that today in your mind? Because we probably won't see rates like this again for at least 2 to 3 years, if not farther.
Sure. No, I think it's a difficult question. Again, I'm not qualified to give investment advice. I don't know. I can tell you what I'm doing with my money.
Let's hear it. Let's that way we can learn from you.
No, I'm very conservative with my money, and I'm probably not listening to my own advice. Generally, I have most of my money is just straight up in cash, kind of as more of an emergency fund, but also just because I've I've been a doomer for a while in terms of the stock market. I haven't felt like the fundamentals have really supported the valuations, but um, the advice I would have told anybody is the markets can stay irrational longer than you can stay solvent. And if you keep your money in cash, you're guaranteed to lose unless you in the very short term can time a big dip. Right now the volatility is kind of crazy. I'm looking into right now, I'm trying to find something that is going to, if there is a stock market devaluation, I'm just trying to find something, an investment vehicle that will do a little bit better than inflation ideally, but something that's going to have a little bit of risk too. So I don't know, maybe I move my money into some bonds here as rates go up, just so I can have some dry powder if there is kind of a significant correction. But honestly, I've been wrestling with that idea for the past 3-4 months. I didn't tell you this, but Toddy and we almost bought a house.
So I know you were in the market. Yeah.
Yeah, we had all of our money, and I know I told you, but had an offer accepted, and it was very close to happening. Didn't end up working out, but
you went all the way through inspection?
No, it ended up being, so what happened is rates rose like the week that we had, and so
you had a pre-approval, rates rose, and then your limits changed.
Right. Well, and it wasn't even,
not your limits, but your,
more into the details, but essentially that's what happened is the rates rose, which puts our level of comfort.
Your monthly payments.
Right. Away from pulling the trigger on it. And in terms of that was where my money wasn't, I needed it to be liquid and ready to get pulled out. So that's where I was then. That's still where I'm at. I have a little bit of money in crypto, not because I think it's a good investment long term, just because
it's like gambling.
I think it's kind of fun to do. But I honestly, I'm not super bullish long term. I would recommend anybody who's into cryptos just to look into what's going on with the stable coin, that USDT coin, Tether, I think is the name of the company. Some shady stuff going on that I think has some broader market implications.
Yikes.
And otherwise, that's, I don't know how to capitalize on the market.
It's so difficult because especially us who aren't homeowners, right? The number one way to gain wealth is to buy homes. That's to buy property. I shouldn't say buy homes, but buy property. In the United States of America, historically, it's been to buy property, because then you have collateral, then you have everything, right? So unless you're just really good at stocks, unless you're just really good at them, which the majority of us aren't. It's been an interesting thing because Jacqueline and I are also in it, and we almost pulled the trigger on a house in January, and it was more of a situation of just the feeling of we're buying it probably at the highest fervor right? We're the highest fervor of the market that we'll see. It's starting to slow down now, especially as as rate hikes go, and if inflation's still a little bit sticky, that could really change the market. Basically, it came down to is if you can be in a situation that you can be patient enough. Let's not buy when there's the most excitement because your options are limited. Options are good in investments. Like you want to look at options. You don't want to buy something that whatever it is, cars, houses, stocks. If you're buying something that
I would say even more, especially with houses, because you have to live there,
yeah,
and it's not like a stock that like stocks are pretty liquid. You can get in and get out,
right.
low transaction costs. With a house, you know,
And it's not fun to move.
yeah. Oh, exactly. No, 100%. I agree with exactly what you're saying. That was a huge part of our calculus. Was I mean, I think making a decision purely based off of the fear of missing out and kind of being in a position of like, well, if I don't get in now, I don't think that it's something that I mean, maybe you'll be happy with it if what you're saying is true, but you could also be wrong. And I don't think it's wise to discount the possibility of, I mean, because like with all the factors that we mentioned, even if rates do go up, typically you see housing prices follow rates in terms of affordability.
Right.
Personally, I would rather buy a more expensive house at a higher rate because I have the option down the line to refinance if rates go lower. But if you
Right.
buy at the bottom,
You can't
you're
refine it. Yeah.
probably
You're stuck.
paying as much as you're ever going to sticker price. Relative to like obviously there's some appreciation that is going to be expected, but
Yeah.
yeah,
That
I don't know. I just I wasn't quite there with pulling the trigger myself. Not that like I think if we would have had a little bit of a higher LTV to start off with, and able to get rid of PMI entirely, I would have felt a lot more comfortable, even purchasing in the current fervor. It was just one of those things where it's like one too many things. The APR I think ended up being like it was like 4% or
yeah.
something compared to what I was looking at previously. It was like I just and to what other people are paying.
Right.
I just
You don't want to
feel like
be the fish at the bottom of the barrel, it, and really I think you make a great point, and that's what I talk to people about is, well, if we're a new home buyer, should we buy right now? And honestly, I tell them that same thing about refi. If you borrow right now, it's going to be really hard in the future to take advantage of your equity because you're never going to refi again if rates stay around 5%, which they probably will as we head towards this. I don't want to call it a recession because I don't think it will be that, but I think a pseudo correction period, in the next 4 to 5 years. Um, and then at that point, it seems scary to buy it that 5-6% of interest, but it'll go down again at some point, when hopefully you're making more of your money in your 30s and 40s and then able to actually do something with that equity in your house. But it's hard because everyone's situation is different and we all need housing. We can't just we have to live somewhere. And it's really hard because people are paying $1,700 a month for rent over here for one bed, one bath. So
yeah, and particularly in the Coeur d'Alene area, I think that there's just I mean, depends on how much you trust some of these rating agencies, but I know that I think Fitch put out a report that had Coeur d'Alene as it was like top three most overvalued
yeah.
areas relative to the fundamentals. Not
Oh,
to say that
absolutely.
like obviously there's resort towns and stuff, but I would just be questioning,
Well, wages
like
is one of them.
right, exactly. How
We can't support it.
sustainable is it to have housing prices this high with wages at their current levels? I don't know. In Europe, like that's the thing. In Europe, you have a higher price to income ratio, and so it's it is a question of like, is that just what's naturally going to happen in America? But the thing that would make me question that hypothesis is that in the United States we have a lot less density than Europe
Bingo.
does.
Yeah,
So
Europe, they have multifamily. They're able to build a lot more units. They've had to, where they have, you know, actually commercial apartments and stuff like that. We don't have that here. We're so used to the model in these rural communities of you have to have a single family home. It's just not, that's not able to happen anymore with the construction costs and everything. At least in this market, we have to get used to the idea of building multifamily and living in multifamily if we want to not inflate our market. But it's a very complicated, because you're not, it's really hard to shift people's perceptions of what they want. And as long as people can pay it, people think, well, it's fine. Who cares the price? As long as people are paying it. Well, those people won't live here forever. And actually, I'd argue that they won't stay at their job forever, whether they're telecommuting or whatever. Eventually, they're going to say, I'm done with that, or they're going to retire or something. Well, if enough of those people decide that, one, we don't want to live here anymore, two, our jobs don't support we're being asked to move back because telecommuting isn't profitable for businesses like it was projected to be, or three, we're just never going to move and hold on our prices. We could be really into a San Francisco kind of type of deal for the long run.
yeah, the issue that I just
But we're not in a
that,
community that's like, we're not as beautiful as San Francisco, and not a port city and everything.
well, no, I don't think, I think it's Rathdrum and Coeur d'Alene area, I think is just as beautiful as San Francisco. I just think the issue is it's the jobs. Like
Right.
if there was a way that people could make $200,000 and you could get 3% of the, even 3% of the population, getting those kinds of jobs, I'd say that, yeah, long term I'd be bullish on those valuations. But unless the whole area is going to become like a total retirement resort type thing, it's just like, how do you have an economy when people can't afford housing? I just think I don't know. It'll be interesting. My prediction is that you will just see a gradual correction. I think the other thing that's interesting that is happening now too is just the rate at which these prices are changing. I think is affected by like Zillow and Redfin.
That's a great point. Talk about big data. Yeah. Talk about big data.
I mean, and you can talk about the inability to capitalize off of big data. I mean, Zillow quit their iBuyers program. I think Opendoor has similar kind of trouble recently. I don't know if they've stopped their iBuyer program too, but these guys are getting out of the business. They have all the data in the world and they're unable to be successful. But I think that's a conversation for another day. I think we are at a
Right.
good length here, and if anybody is listening to this, I want to.
We'll trim it up. We'll trim it up.
Enough.
Yeah. Well, I appreciate your time, Gavin. Tell Toddy hi for me.
Yeah, we'll do. Thanks so much, Tyrell.
Yeah. Thanks, man. We'll talk soon.